Hello everybody, I'm Dean Barber, founder and CEO of Barber Financial Group. Stick around for the next few minutes as I walk through market valuations, expected long-term returns based on current market valuations, and where we are right now in the economic cycle, where the markets are, and what we think is ahead. Let's get started with market valuations. We've been through this the last couple of months, and you've probably heard me talk about market valuations on America's Wealth Management Show. I want to show you a chart here that shows the CAPE ratio. That's the cyclically adjusted price to earnings ratio. So we're going to look at that from a historic perspective first, and then we're going to take a look at what long-term average returns are when CAPE ratios are at the level that they are today. So first of all, as you can see on this chart, our CAPE ratio is nearing 37. It's the orange line here. The only time in history that it's been higher is during this dot-com bubble era. And if you all remember, during the dot-com bubble era, when the market started falling, we were able to go forward for a total of 13 years before the markets fully recovered where they were at the peak of the market in the dot-com bubble. Now, valuations we know can go higher than they are today. And just because we have high valuations doesn't mean an imminent bear market is at hand. What it does mean though is that it's time to step back and take a look at where you are overall. Here's why. If we look at this chart, it shows 10-year total returns. Now this is total return. This is not an average annual return. This is a total return. When you have CAPE ratios over 35, look at these 10-year total returns. We're anywhere from a negative 5% to a positive, 4% on the high side? Total return over a 10-year period? That's not acceptable. So we have to be smart about where we are today. We're going to have to understand that we may need to be more dynamic. We may need to go back to some actively managed funds that seek out value in companies and try to find the companies whose stock prices are not as overvalued as the market itself. There's going to be areas that we're going to want to avoid. Now, most of you recall that we really laid into the portfolio a lot more small and mid-cap stocks back in January. So I want to talk to you about what's going on in the market overall. So if we look at the market overall, just in the last month, you have the NASDAQ coming back up 6.31% for the month of June, followed by the S&P 100 up 2.8%, S&P 500 gaining 1.82%, Russell 2000 small caps up 1.7%, and the S&P 400 mid cap down 1.37%. So pretty big divergence from a positive 6.31 to a negative 1.37. If we look at it on a year-to-date basis, we change the scope a little bit. And I want you to look at what's down here towards the bottom, and that's the NASDAQ, 13.15. And remember, it made over 6% just right here in the month of June. And the S&P 600 small cap, the clear winner year to date, up 22.42%. Mid caps, Russell 2000 all up almost 17%. So S&P 500 up about 14.5%. These would be great returns for a 12-month period. Chances are your portfolios have gotten a little bit heavy into equities. What I want to encourage you to do here is during your next review with your financial advisor, I want you to take a look at that portfolio. If you want to discuss it before that, we're always welcome, always welcome to give us a call and we can talk about where your portfolio is overall. The thing is that this would be a time where you may want to consider doing some rebalancing, taking a little bit of the winnings off the table, setting it over into a safer spot. We did a piece on bonds here last month. I encourage you to go back and watch that again. We're going to talk about inflation. I didn't want to do it during the economic update. There's all kinds of headlines out there on inflation. We're actually working on an article that we expect to have out to you here within the next couple of weeks on inflation and commodity prices, so be on the lookout for that. We dive into a great deal of detail on what we see happening on the inflation front. So with that, I just want to encourage you to always make sure that you keep us informed on where you are as far as your risk tolerance, your spending goals, etc. We know we do that with you on a regular basis when we sit down and review your financial plan, but stay in constant contact with us. Let us know if you've got questions or concerns. We're always here to help. Thanks so much for joining me today. Whether you're watching me on social media or on YouTube, make sure to share this with your friends, give us a thumbs up, and subscribe.